Hey guys, this is going to be a quick episode which I will explain the ICO incentive model for investors and comparing it to equities and how equity works. And we will come to a conclusion in which we will showcase how the ICO could never work based on a lack of logic, even if there would be a perfect world with no scams and perfect utility. So let's get started. Before I'm going to get into the ICO, I'm going to start by explaining the equity model. So the equity model is pretty simple. You usually start with seed round, friends and family. Then you do a round A at a slightly higher valuation. Then you follow up with a round B at an even higher valuation. And you grow your valuation with time. You end up with an IPO. And then the company goes trading. So there is a pre-IPO phase and a post-IPO phase. So let's start with the pre-IPO phase. I'm an investor and I want to invest in this company and I have an option. I can invest in seed or I can wait a bit and invest in option A. So what does that mean for me? If I invest in seed, I potentially can make some more profits, but I also have more risk because the round A will most likely be 6 months or a year later. So I have 6 months time to watch and follow the company. The longer I view a company, the more I can observe their behavior. The easier it is for me to assess how risky this investment is. So I can take away this investment by not investing in the seed. I can wait until A, but potentially if it does well in this 6 months to 1 year, then the valuation could also grow very much, right? Because of this opportunity cost. There's no hyperliquidity. Hyperliquidity would happen in post-IPO stage in which I can enter here, I can enter here, I can enter whenever I want, right? I can just watch them and say, now I want to go in. Here, you cannot enter either in the middle of the stages. You have to wait for seed or you have to wait for A, B, C. So that's pretty simple. If I don't invest in C, I get less risk, but I might also get less reward. That makes sense. Perfect incentive system for the investor. So I'm not a super risky investor. I prefer to watch the company. I see how it grows for 6 months. I see it does well. Now, okay, they did well, therefore their valuation increased. So I'll buy here. So that happens in A, B, C, and IPO. The second core difference between the pre-IPO phase and the post-IPO phase is that all the stocks that are sold to investors are always sold by the company itself. So the company trades their stocks against funding to make the stocks more valuable. However, in the post-IPO phase, what happens is if I buy a stock here, I do not buy it off the company, I buy it off someone else, right? So the money goes to the other trader and there's some benefit for the exchange. Essentially, what that means is if I buy the stock here, the company doesn't get my money. If I buy the stock anywhere here, the company will get my money. So the second core difference is there is hyperliquidity, so there is no opportunity cost. I can just watch it, and if I like it, I go in. So that's simple, makes perfect sense. Now let's take a look at the ICO model. So the ICO model is usually set up in two phases. There's the private sale, and then there's the ICO or a IEO. Nowadays it's more often IEOs than ICOs, but this video is going to be more about ICOs. So the private sale starts usually a bit earlier. It's about usually 6 months in between, and they have a better valuation. So what that means, let's say the company values itself at $10 million, and then it values itself at $25 million. So you have some more risk, same as before, and you have a little bit more, you have more rewards essentially, because if the company goes up from here, then you make much more profits than this guy. Once the ICO is over, or the IEO is over, the company starts going trading. It looks a bit like this. If the company does not go up, it quickly goes down, because nothing stays stable in crypto. So now let's compare these two models. If the company does go up, then it usually will go up and then it will go down afterwards. So why is this? The main reason is the company needs to evaluate itself at a higher price, or they usually do, than their current fundamental value. Let's put their current fundamental value here. People say it's kind of difficult to evaluate ICOs. I think that's kind of not true. You just look at the buybacks. If there's no product, if there's no utility for the token, no staking, no buybacks, no burns, the company valuation is technically zero, or it's very low. Let's call it 1 million. So this is the fundamental value of the company. However, they raised a lot more higher than that, because during the ICO phase, and especially during this first week, the fundamental value has nothing to do with the value which it sells, because there's only one reason why you would want to buy here. Because you know, as the asset is hyperliquid, a hyperliquid asset will always tend towards a fundamental value as price discovery happens over time. So usually ICOs look like this, and then they have product launch, let's call this, and then if there's a product launch, ICOs can go up and moon, right? This happens every now and then. It doesn't happen often, but sometimes it does happen. This is product launch. So if you know that buying an ICO would not make sense because it's a hyperliquid asset, and a hyperliquid asset will always tend towards a fundamental value, you can get a better time. So the company has more value as it had, let's say, 1.5 years building its product, but you also get a much lower price. And you know this as a fact, then why would you ever buy here? So the reason people buy ICOs and IOs is because of they think they're getting the lowest price. Right? The same reason you want to get the lowest price here. However, they get the lowest price for a short period of time and then they can sell it again. So how do you know if you get the lowest price? It's pretty simple actually. You have demand on ICO plus demand on private sale divided by circling supply, dollar value essentially. Now a lot of IOs are kind of scammy. They, instead of reducing the valuation, they decide to sell 1% of the circling supply, essentially bringing down the dollar value of the circling supply very low. But these coins quickly tend towards minus 99.9% of price as the company starts dumping the overvalued price. Therefore, the reaching its fundamental value again, right? Price just tends towards fundamental value in a hyperliquid asset very quickly. So if this demand of ICO plus demand of private sale is larger than 1, let's make it larger, equals or larger than 1, then you can assume that there's a high chance that you will get the lowest price for a short period of time and you can sell it here. This is called flipping, right? It's a flip. People like to flip. Now, if you care about a company and you think it's a really good company, you want to hold it for the long term, then you would most likely invest here. And I'm going to explain even why some companies say if they start with a mainnet, then they will instantly go up. But that cannot be true either. Because in a utility token, in order to reach adoption for the token, you need the token to be liquid. So let's draw a line here. Let's make it red, and this orange red line represent the adoption curve. Actually, it's a bit later. So that's the adoption curve. Adoption curve is just basically a time in which your product goes to market, people learn about it, etc., and it gets usability. Which means if you start with a mainnet and you go launching the product right away, it's still going to take some time until the token becomes useful. At the same time, there will not be demand for the token unless it does go trading and becomes liquid. So you have a serious problem here. Because you know, if it goes liquid, it tends towards the fundamental value. You have to raise it a higher valuation in order to build a product. So there's always going to be a time in which the token value tends towards the fundamental value, while the fundamental value grows, and you have this adoption curve, is the point in time when a smart investor buys the token. Like this happens on the secondary market. It's just called secondary M. The problem is, these are the people that would buy the coin for the company itself, for the utility of the coin. Here are people who buy it for this reason, for the flipping. However, the flipping has nothing to do with the company itself. Now the core problem is that the company only will get these funds, right? These are the only funds the company gets. the funds which come, the people who buy the token for the company itself, well, they don't buy them off the company, they buy them off someone else, right? These people, essentially, the ICO people. Essentially meaning that the people who want to buy the company for the company do not give the company funding, and therefore the company can never even build the product in the first place in order to reach maturity through the adoption curve. Yes, essentially a broken system. Because nobody would invest here because they know it's going to go down. Now people can say, why don't just raise a lower valuation? Now people do that. The problem with a lower valuation is that it's very hard to create a utility for a token in which people constantly reduce the value of it by dumping more tokens. And that is the problem with the hyperliquidity of tokens. Now, smart investors wait 1 year, buy a much better token, a much better ICO, that's been working for 1 year with good funds. At this point, when they can see that there's some small amount of demand, utility demand for the token. And that's the perfect time to buy. Thank you for your time. This was why ICOs can never work.